So now you own shares of an airline stock. What next? Well, you can sell call option contracts against the stock that was just put to you. Let's go back to our real estate example to show you the concept. Assume you bought the rental house in our previous example for $100,000. You like collecting rent each month, but the market has improved a bit and you're open to selling it for $150,000 if you could get that price. You tell a friend what you're thinking and he's interested in buying it from you. He just needs to wait 3 months to receive an inheritance, plus he wants to do some research on the neighborhood. Now you're interested in selling it to him, but you're not keen on giving him 3 months to get the money together. You could get a better offer in the meantime, and then you'd be stuck. So your friend proposes a great idea. He proposes to pay you $5,000 today to hold onto the house for 3 months. Now, if he decides he wants the house after 3 months, he has a right to buy it from you for $150,000. And if he decides not to, he can walk away. But either way, you get to keep your $5,000. Sounds like a good deal for you, right? It is, and it's precisely how my income on demand call option strategy works. Remember, when somebody buys a call option, they have the right to buy 100 shares of stock at a specific price. The person who sells the call option has the obligation to sell 100 shares of the stock at the specific price as long as the buyer decides that he wants to exercise his option. Now, let's go back to our airline stock that's trading at $24. Remember, we bought the stock at $25 after selling a put contract for $1.50. So we're up 50 cents per share on our position. Now, since you own 100 shares of stock, you can sell a call contract that gives another trader the right to buy the 100 shares of stock from you at $25. Now, the price that you get for selling the call contract depends on the market price. But let's assume that you can sell a 3-month call option with a $25 strike price for $1.50 per share, or $150 per contract. You can instantly collect $150 in income simply by selling this call contract. Plus, you still have a chance to make back $1 per share on the stock if it rallies back above $25. So here's what can happen. First, if the shares trade back above $25, the investor who bought the call option contract from you will have an incentive to exercise his right to buy the shares at $25. After all, why would he pay a market price for the shares above $25 if he chooses to buy the shares from you at $25? Now, if he chooses to buy the shares, you'll get the same price that you paid for the shares when they were put to you or when you bought them last month or 3 months ago. Plus, you collected $1.50 per share from selling the put contracts. And don't forget the $1.50 per share that you received from selling the call contracts. Now, all things considered, by selling the puts and then buying the stock, and then we sold the calls and we finally sold our stock, you would have received a total of $3 per share or $300 per contract of income. That's fantastic. Now consider you sold the stock for $2 per share less than it was trading for you when you first sold the put contract. Now let's look at the second potential scenario. If shares stay below $25 when the call contracts expire, you get to keep the money that you received when selling your call contracts, and you get to keep your shares of stock. The buyer of your call contracts won't buy your shares at $25 when he can buy them cheaper in the market. Once the calls expire, you can sell more calls against your stock for more income. Plus, you can keep any dividends paid by the airline stock during your ownership. With my income on demand strategy, you can often sell several call contracts against the stock that you own, generating income month after month after month. This is a far superior and safer way to generate income than holding a stock and collecting dividend payments alone while hoping for its share to appreciate. We'll wrap things up in our final video segment.